the profits prior to incorporation refers to all those profits which are earned by the company before the registration of the company. Once the gross profit is known, then you just apportion the profit between pre-incorporation and the post-incorporation. Preliminary expenses related to the formation of the company. That is, all expenses in connection with the incorporation or registration, we call them as preliminary expenses. Hello my dear students, I am Purnima, faculty in the Department of Commerce and Management, Vidhyaashram First Grade College, Temple of Excellence, MYSURU. I welcome you all to this session. In this session of Unit 2, Session 1, we will be having a discussion on profits prior to incorporation. This is the second chapter prescribed for second year BCom. So let us see what is this profits prior to incorporation. So in this introduction slide, if a new company is formed exclusively to acquire a business unit and take it over as a going concern from a date prior to its own incorporation, then the business unit is purchased first and the registration of the acquiring firm takes place at a later date. So, what do we mean by profits prior to incorporation? So, incorporation means registration. Now, in this, what happens to the profits which are earned by the firm before the registration? So, the profits prior to incorporation refers to all those profits which are earned by the company before the registration of the company. So, suppose if it is a sole trading concern or a partnership kind of organization which is taken over by a joint stock company, then the profits whatever is earned by that business firm cannot be considered as profits of the company. So, the company comes into existence only after it is properly registered, or until and unless the company gets the certificate of incorporation, we cannot call it as a company, or in other words, the certificate of incorporation is the birth certificate of the company. So, whatever the profits the company earns after the registration, after the incorporation, that is the profit which has to be shared among the shareholders, and that profit we consider as the revenue profit, and the profits which are earned by the business firm before the incorporation, that we call it as the capital profits, and it will be taken to the capital reserve. So, the business unit is purchased first and registration of the acquiring company takes place at a later date. In such cases, it becomes necessary that accounts of the existing businesses should be balanced and stock taking should be undertaken. So, when this happens, we have to say that the accounts of the existing business should be balanced and stock taking should be undertaken. So, whatever is the stock taking, we have to have a stock of whatever is there. The account treatment of profit or loss prior to incorporation is totally different from post-incorporation profit or loss. Thus, it is necessary to compute both the amount of profit or loss prior to incorporation and post-incorporation profit or loss. So, whatever the profit or loss we gain before the incorporation, that will be treated as capital profit or capital loss, and the profits after incorporation will be considered as revenue profit or revenue loss. Now, the profit or loss prior to incorporation refers to the profit earned or loss suffered by the company from the acquired business before it legally came into existence. That is, from the period from the date of acquisition of the existing business to the date of incorporation of the company. Suppose the company was acquired on 1/4/2020 and it is registered on 1/8/2020. So, this is the date of registration, this is the date of acquisition. So, what happens here? April, May, June, July, 4 months. So, the profit earned in this 4 months, it cannot be considered as profits of the company. So, legally, this profit is not available for distribution as dividend, since a company cannot earn profit before it comes into existence. Profit earned before incorporation is a capital profit, and profit earned after incorporation is a revenue profit. So whatever profits are earned here in this period, so this we call it as the capital profits, but it cannot be shared among the shareholders. Then post incorporation period begins after the incorporation and ends with the closing of the accounting year. Suppose the business is acquired on 1/4/2020 and it is registered on 1/8/2020. The books of accounts are closed on 31/3/2021. Then whatever happens here, so here it is 4 months, this 8 months. So whatever profits are earned in this 8 months, so that will be called as the post incorporation profits. So the profits or losses earned during this period are referred to as post incorporation profit or loss. These profits are revenue profits which can be used for distributing dividend to the shareholders. So these profits are the revenue profits which we can help to distribute to the shareholders. So revenue profits can be distributed among the shareholders, whereas capital profits cannot be distributed among the shareholders. What are the different methods of computing profit prior to incorporation? There are two basic methods. In this, the first method is the profit and loss account is prepared separately from pre-incorporation period and the post-incorporation period. Now, if again I take the example of 1/4/2020 to 1/8/2020. So, this is the pre-incorporation period, that is 4 months. Then 1/8/2020 to 31/3/2021. This will be 8 months. This is post-incorporation. Now, on the date of incorporation, the stock is taken, final accounts prepared and all the old books of accounts are closed. Though this is a simple method and gives accurate results, it is considered as inconvenient and expensive, as during this implementation, business activities need to be stopped for some days for the purpose of stock taking. Due to these drawbacks, this method is not much popular. So, one method is, here we have to just calculate the profit and loss up to this for only this 4 months and then we close the books of accounts. But this method is simple and gives accurate results, but then it is inconvenient as we have to have a stock taking of whatever the stock the company has. So, that is why this is not very popular. Now, the second method, so the profit is calculated in the following manner. First, a combined trading account is prepared for the entire period, that is pre-incorporation as well as the post-incorporation period. Now, we have a trading account and then we just have the gross profit. Allocate the gross profit earned and expenses incurred between the pre-incorporation and post-incorporation periods on the basis of the following principles. Now, you have the following principles. So, what is this? The first one is the gross profit is allocated in the ratio of sales of each period. So, you have a trading account, you ascertain the gross profit. Once the gross profit is known, then you just apportion the profit between pre-incorporation and the post-incorporation. Then, fixed expenses are allocated on the basis of time. So, gross profit is shared on the basis of the sales ratio and the other expenses will be shared on the basis of the time ratio. Time ratio means the period between the date of acquisition and the date of registration and from the date of registration to the closing of the books of accounts. Now, expenses related to sales are allocated in the sales ratio. For example, we have the traveler's commission, then we have the discount allowed, advertisement, salesman's salary. So, all expenses related to sales, they will be based on the sales ratio. Expenses related to time are allocated on the basis of time ratio. For example, insurance, depreciation, salaries of general staff, rent, rates, taxes, etc. If expenses are specifically related to pre-incorporation or post-incorporation period, then such expenses must be allocated based on the profits of that specified period only. Then expenses which are charged to post-incorporation profit are preliminary expenses. Now, what are these preliminary expenses? Preliminary expenses related to the formation of the company. That is, all expenses in connection with the incorporation or registration, we call them as preliminary expenses. Then we have the directors' fees. So, who are the directors? The board of directors, they will be comprising of the top management of the company. So, whatever fees we pay to them, so that has to be charged under the post-incorporation period. The debenture interest. So, the debenture comes into existence only after the company is registered. Then director's salary, etc. Expenses which are charged to profits of pre-incorporation period are partners' salaries, interest on partners' capital, etc. Suppose a partnership firm is being taken over by a company, then partners' salaries, interest on partners' capital, all of them have to be charged to the pre-incorporation period. Then next, let us look into what is the meaning of time ratio. Time ratio refers to the ratio of two periods, that is pre-incorporation and post-incorporation period. Pre-incorporation period is which falls between the date of acquisition and the date of incorporation, whereas post-incorporation period is the period which falls between the date of incorporation and the closing of the books of accounts. So, the date of acquisition, if it is 1/1/2020, then date of registration is 1/5/2020. Then date of accounts, closing the books of account is 31/12/2020. Then here we have 4 months, here we have 8 months. So, the time ratio is 4:8 or 1:2. The formula for calculating time ratio can be expressed as pre-incorporation period in months and post-incorporation period. So, pre-incorporation period is 4 months, post-incorporation period is 8 months. So, when we simplify this divided by 4, I get 1:2. So, the time ratio is 1:2 in this case. Then next, let us go for the sales ratio. So, if the turnover is uniform for all the months of the accounting year, then it becomes quite simple and easy to calculate the sales ratio. So, if the turnover is uniform throughout the year, then we can calculate the sales ratio easily. If in case the turnover differs from one month to another month due to the nature of the product, and then calculations of the sales ratio becomes difficult. For example, variation in sale of sweaters. There is more demand during winter when compared to that of other seasons. Therefore, in such cases, sales ratio is calculated by taking into account the relationship of monthly sales with the total sales. So, sales ratio is, so if the sales is uniform throughout the year, then the sales ratio can be calculated easily. But then if it is varying, then we have to make the necessary adjustments. Then next one is the purchase ratio. The calculation of purchase ratio is similar to that of the sales ratio. If the number of purchases for all months in an accounting period is uniform, then the calculation of purchase ratio becomes easy. But if it differs from one month to another, then it becomes difficult to calculate the purchase ratio. So, similarly, just like the sales ratio, purchase ratio also has to, if it is same throughout the year, then we won't have any difficulty in calculating the purchase ratio. So, the ratio of purchases in the pre-incorporation period and the purchases in the post-incorporation period. So, this is how we have to calculate the purchase ratio. So, if the purchases in the pre-incorporation period is 8 lakhs and the purchases in the post-incorporation period is 16 lakhs, then we can say that the ratio of purchase is 1:2. Then next we have the weighted ratio and the weighted time ratio. If in case the expenses like salary which varies because of the increase in number of workers due to change in the ownership of the business, the weighted ratio is calculated. In this ratio, the time and number of workers in both pre-incorporation and post-incorporation period are taken into account. And when we have lot of workers for at least 3 months, then we use this weighted ratio. So, for 3 months into the number of workers into the wages, so we get the weighted ratio. Then, so here we have the list of items which are to be divided on the basis of the sales ratio. The first one is the gross profit, second one discount allowed, carriage outwards, selling expenses, salesman's commission, salaries of salesmen, sales promotion expenses, bad debts, delivery expenses, free samples, advertisement expenses, variable distribution expenses, after sales service cost. So, these are the list of items which are to be allocated on the basis of the sales ratio. Next, the time ratio. On the basis of time ratio, we have to share these expenses. Salaries of the general staff, rent, rate and taxes, insurance, general expenses, printing and stationery, office expenses, administrative expenses, audit fees, miscellaneous expenses, depreciation, fixed distribution expenses, fixed expenses, interest on purchase consideration, bank charges, repairs, fuel, interest on loan, etc. So, all these are on the basis of the time ratio. So, we have a problem here which is based on profits prior to incorporation. So, Purojay Limited was incorporated on 31st July 2020 to take over an established business from 1st April 2020. So, the business was taken over on 1st April 2020, but the business was registered on 31st July 2020. The company prepared its final accounts on 31st March 2021. During the year 2020, the total sales were 48 lakhs, out of which the sales from 1st August to 31st March was 30 lakhs. Calculate the time ratio and the sales ratio. So, this is a problem where we have to calculate the time ratio and the sales ratio. So, they have given us the date of acquisition, the date of registration, the date of closing the accounts. They have also given us the sales relating to pre-incorporation period and the post-incorporation period and the total sales. Now, here is the solution. Now, what is the pre-incorporation period? Pre-incorporation period is 1st April 2020 to 31st July 2020. So, this comes up to 4 months. The post-incorporation period is 1st August 2020 to 31st March 2021. So, this is a period of 8 months. So, the time ratio is 4:8 or 1:2. The calculation of sales. So, total sales is given as rupees 48 lakhs. So, this is the total sales given. The pre-incorporation period sales is 1st April 2020 to 31st July 2020. So, the pre-incorporation period sales is 18 lakhs. So, this 48 lakhs minus 30 lakhs is 18 lakhs. So, the post-incorporation period sales is 30 lakhs. So, the sales ratio will be 18 lakhs is to 30 lakhs, that is 18:30 or 3:5. So, we have the time ratio and the sales ratio. Now, problem 2. Sunlight Limited was incorporated on 1st April 2020. The total amount of wages paid is rupees 8 lakhs for the year ending 31st March 2020. So, in the pre-incorporation period and the post-incorporation period, the number of workers are 40 and 120. Calculate the weighted time ratio for allocating the wages of pre and post-incorporation period. So, this is a problem based on the weighted time ratio. So, let us see here. So, what is the simple time ratio here? 3 months and 9 months, that is 1:3. So, the weighted time ratio into number of workers. So, 1 into 40 is as to 3:120. So, 40:360 or 1:9. The total payment of wages is 8 lakhs. So, in the pre-incorporation period, it will be 80,000 and in the post-incorporation period, it is 7,20,000. So 8 lakhs into 9 by 10, that comes up to 7 lakhs 20,000. Next, we have this problem 3. Satyam Private Limited acquired the business of Sundaram Private Limited on 1st April and was incorporated on 31st July 2020. So the date of acquisition is 1st April 2020. The date of registration is 31st July 2020 and obtained the certificate on 1st August. The accounts of the company for the period ended on 31st March 2021. So these dates are very important to calculate the time ratio. The turnover for the whole period amounted to 8 lakhs, of which 2 lakhs related to the period from 1st April to 31st July. So from 1st April to 31st July, the company has earned a profit of 2 lakhs. Out of this 8 lakhs, 2 lakhs belongs to the pre-incorporation and the rest of the amount, that is 8 lakhs minus 2 lakhs, that is 6 lakhs, it belongs to the profit in this period. So the gross profit for the year was 2 lakhs 50,000. The expenses debited to profit and loss account were as follows. So they have given us the list of expenses which are to be debited to the profit and loss account. The rent rate and taxes 90,000, salaries 1 lakh 50, directors fees that is 38,000, audit fees 20,000, general expenses 48,000, preliminary expenses 18,000, printing and stationery 36, bad debts, out of which 2,000 related to pre-incorporation. So out of this 2,000 is pre-incorporation, 4,000 will be post-incorporation, advertising 18,000, interest to vendors 8,000. So ascertain profit for pre and post incorporation period. So we have the format here. The first thing is you have to write the heading. What is the heading? Statement showing apportionment of profit and loss account between pre and post incorporation period for the year ending 31st March 2021. So we have here 5 columns. So the profit and loss account will always be in the vertical form. So we have the particulars, basis of allocation, total, pre-incorporation, post-incorporation. So usually the first entry will start from the gross profit. So the gross profit, it is divided on the basis of sales ratio. So the total gross profit is 2,50,000. So 2,50,000, I have to divide it on the basis of sales ratio, that is 1:3. So 2,50,000 into 1 by 4. So that is 62,500, 1,87,500. So I have just divided the profits on the basis of sales ratio. I am getting 62,500 and 1,87,500. Then we have the expenses here. So the 90,000 I have divided on the basis of 1:2. That is 30,000 and 60,000. Salaries also 50,000 and 1 lakh. So directors fees will directly go to the post incorporation period. Then audit fees 20,000. So I have shared it in the basis of time ratio, that is 1:2. General expenses is 48,000, that is 16,000, 32,000. Printing and stationery 36,000. So again we have divided in the basis of time ratio. Bad debts 6,000. Pre-incorporation they have already mentioned as 2,000. So 4,000 goes to post-incorporation. Advertising 18,000. So 4,500, 13,500. Preliminary expenses 10,000. It goes directly to post-incorporation period. Interest to vendors, it will be on the basis of the time ratio. That is the date of acquisition and the date of payment. So if you can see here, the turnover for the whole period they have given. The date of acquisition of the business is 1/4/2020. It was incorporated on 31st July 2020. Then they have just told us that The payment was from 1/4/2020 to 30/11/2020. For a period of 6 months, we have to calculate the interest. So, the interest will be divided on 1:1 basis. That is 3 months prior to incorporation, 3 months after incorporation. So, it will be shared as 4,000 and 4,000. So, the total will be 4,24,000 total of the expenses. Total of the expenses here is 1,25,167. The total of the expenses here is 2,98,833. Now, you deduct from 2,50,000, you deduct 4,24,000. We are getting a negative sign, that is minus 1,74,000. Now, from 62,500, you deduct 1,25,000, you get 62,666.77. From 1,87,500, you deduct 2,98,833, 1,11,333. So, this is a capital loss here. Whatever the loss we got in the pre-incorporation is capital loss. In the post-incorporation, it is called as the revenue loss. The date of purchase is 1/4/2020. Date of incorporation is 31/7/2020. Date of closing account is 31/3/2021. So, the 4 months between 1/4/2020 to 31/7/2020, it becomes pre-incorporation period. So, April, May, June, July, 4 months. Now, from July to next March, it becomes 8 months. July, August, September, October, November, December, January, February, March. So, from July it is here. So, August, September, October, November, December, January, February, March. So, it is 8 months. So, the time ratio is 4:8 or 1:2. Calculation of sales ratio. Pre-incorporation is 2 lakhs. Post-incorporation is 6 lakhs. So, the sales ratio is 2:6 or 1:3. Next, the calculation of bad debts. The amount of bad debts relating to the pre-incorporation period is given in the problem. What is the amount of bad debts? 2,000. Actual bad debts is 6,000. So, 2,000 plus 4,000, you get 6,000. Then calculation of interest to vendors. So, 1 lakh into 12/100 into 8/12. So, the pre-incorporation is 4 months. Post-incorporation is 4 months. So, the ratio is 4:4 or 1:1. So, the pre-incorporation 4,000, post-incorporation 4,000. With this, we come to the end of this session. Hope you have all followed it. Thank you.